Hello everyone, I am Atika and I'm going to talk to you about course MB 2203 Financial Management. On this session, we will talk about cash flows and financial planning. We will begin with depreciation. Depreciation is the portion of the cost of fixed assets charged against annual revenue over time. So maybe you're wondering why we begin with depreciation when we are talking about cash flows and financial planning. If you remember your income statements, we have depreciation expense, right? However, it's not really a cash outflow. There are several methods for depreciations. However, in this session, we will talk about two methods: modified accelerated cost recovery systems or MACRS, and also straight line methods. Modified accelerated cost recovery systems or MACRS is the depreciation system that mostly common used in the US. It is the depreciable value of an asset in its full cost, so it also includes your installment costs and other costs when you bought the asset in the first time. And in MACRS, we have the year of recovery determined based on the categories of the asset itself. So here we have the percentage of recovery years based on categories of recovery years. We have 3 years period, 5 years period, 7 years period, and also 10 years period. So how we determine which categories of recovery year our assets into? So 3 years period, usually for research equipment and also similar special tools. And what about for 5 years? 5 years usually for computers, printers, maybe light heavy trucks. And for 7 years, it's usually for furniture and most manufacturing equipment. And for 10 years category, usually used in assets such as big equipment in oil and gas refining, maybe in food manufacture, something like that, the bigger asset. And now we have the straight line methods. It is quite simple because it is what is usually used in Indonesia, and it is very simple method because we only have to divide the acquisition value minus the residual value with the estimated lifetime. So we have to know the acquisition value or the value when we bought it, and then we estimate how much the residual value or the leftover value by the end of its lifetime. Then we have to divide the value, and then we get the depreciation value for each year. So the amount of depreciation expense is the same for every year. It's different with the MACRS because in MACRS, in the first year, in the beginning year, the percentage is much higher than the end of the period. That's all for this session. I hope you learned a lot and find something useful for you from this course. I will see you soon for the next part. Bye!